All right, let's get right into it. Welcome to this explainer on Adeia Inc. Today, we're breaking down the Q1 2026 performance of a quiet but absolutely vital player in the tech space. If you've been following the massive explosions in artificial intelligence and next-generation media, you definitely know the big names. But today, we're taking a value investor's approach to look at the foundational architecture behind those names.
Now, I want you to think about this number for a second. 60%. Seeing a staggering 60% adjusted EBITDA margin absolutely stops you in your tracks. This belongs to a $3.27 billion company that operates almost entirely in the shadows. In an era where hardware manufacturers are fighting tooth and nail over tiny percentage points of margin, Adeia is commanding a massive 60% margin while quietly powering the AI and media boom. So how exactly are they pulling this off?
Section 1. The Adeia business model, or what I like to call the picks and shovels of the tech world.
You know that old gold rush saying, right? The folks who really struck it rich weren't the miners, they were the ones selling the picks and shovels. Well, ADEA is doing exactly that through IP licensing. They're not out there pouring billions into fabricating silicon chips or building heavy, expensive server racks. Nope, instead they invent the underlying technology. They make their money by letting other massive tech companies use their patented tech across media, consumer electronics, and semiconductors. By completely bypassing those heavy, capital-intensive manufacturing costs, they've built a really wide economic moat to protect those incredible profit margins.
And here is where that durable competitive advantage really shines. Over 13,750 worldwide patent assets. I mean, we're not talking about a handful of good ideas here. This is a massive foundational portfolio. It basically makes Adeia an unavoidable toll bridge for the major tech brands. If you're building a smartphone, a smart TV, or a high-density AI server, well, there's a really high probability you're going to have to license a piece of Adeia's intellectual property just to make it work.
Moving on to Section 2. The Q1 2026 financial snapshot and how they're beating Wall Street expectations.
Looking at their recent earnings, Adeia delivered a really solid beat. Wall Street was looking for an earnings per share of 36 cents, but Adeia actually came in at 38 cents per share. And it wasn't just the bottom line. Revenues for the quarter hit $104.77 million, which comfortably topped the $99.72 million estimate. So right out of the gate in 2026, we're seeing clear top and bottom line outperformance.
But, beyond the top-line beats, what really gets me excited is their disciplined capital allocation. Any company can generate revenue, but if management squanders the cash, it doesn't do us any good as investors. Well, in Q1, Adeia generated $58.5 million in operating cash flow. And what did they do with it? They paid down $28.1 million in debt, bringing their total remaining term loan under $400 million. And they aggressively repurchased $10 million of their own stock. Able and honest management, right there. Oh, and the cherry on top? S&P Global Ratings actually took notice of this financial stability and upgraded their credit rating to BB.
Section 3. AI and Semiconductor Tailwinds. Let's build the bull case.
So what's the real long-term prospect here? It all comes down to technologies like hybrid bonding, which is exactly why Adeia is suddenly so critical to the AI boom. Look, as AI models get infinitely more complex, hardware makers can't just keep making chips wider, right? They literally have to start stacking them vertically. Hybrid bonding is an advanced semiconductor packaging technology that makes this 3D integration possible. It increases interconnect density, boosts speed, and seriously improves power efficiency. Adeia licenses this exact critical technology to power those crazy high-density generative AI workloads.
And let me tell you, the big players are absolutely signing up. Look at these major Q1 strategic wins. They secured a multi-year semiconductor hybrid bonding license with AMD. And get this, management expects AMD to become a massive, greater than 10% customer going forward. That is huge. They also locked in a multi-year media portfolio license with Microsoft, and they even successfully expanded into e-commerce by licensing their media IP to L'Oreal. It's a textbook example of incredible diversification across multiple, massive industries.
To really hammer home their tech credibility, listen to this. LexisNexis just named Adeia one of the top 100 global innovators for 2026. This isn't just about having a ton of patents. It's an objective measurement of patent quality and actual industry impact. When you combine this with their award-winning rapid-cool liquid cooling innovations, which are absolutely crucial for those extreme power density data centers, it's super clear that Adeia is sitting right at the cutting edge of the AI hardware revolution.
Okay, Section 4. Headwinds and near-term risks. Let's look at the bear case.
Now, as investors, we always have to look objectively at the risks to figure out our margin of safety. And right now, Adeia is navigating two very different realities. On one hand, their non-pay TV recurring revenue, so the new innovative stuff, grew an impressive 28% year over year. That's fantastic. But on the flip side, overall recurring revenue dropped sharply from $94.5 million down to $66.3 million. Why the big drop? Well, they are still heavily exposed to legacy pay TV, and as folks continue to cut the cord, those older revenue streams are shrinking pretty fast.
Plus, there are some pretty gritty immediate corporate hurdles they're dealing with. Adeia is currently locked in a major dispute with Dish Network, a long-standing customer that decided not to renew their license. That obviously creates some near-term revenue uncertainty and the potential for hefty litigation costs. On top of that, after 15 years with the company, CEO Paul E. Davis announced he's stepping down by the fourth quarter of this year. Executive turnover always introduces a level of transition risk that the market just has to digest.
Which brings us to Section 5, Analyst Forecasts and Valuation, Wall Street's Verdict.
So how is the market actually valuing this mix of massive profit margins and those corporate headwinds we just talked about? Well, looking at current analyst price targets, the stock is trading right around $29.53. The most conservative low target is $30, which, still offers a slight bump. But the average median target sits at $37.50. That implies a roughly 27% upside from current trading levels. And the most optimistic analysts, they're eyeing a high target of $43.
And when you look at the consensus among the top analysts covering the stock, it's really telling. 4 buy ratings, 0 holds, and 0 sells. It's literally a unanimous bullish consensus. So despite those near-term headwinds with the Dish Network dispute and the upcoming CEO transition, Wall Street clearly believes that Adeia's highly profitable IP licensing model and those massive AI tailwinds heavily outweigh the risks.
Which leaves us pondering this final question. Is this a wonderful business at a sensible price? Will Adeia's massive patent portfolio outrun its corporate headwinds? Can their 60% profit margins and growth in next-gen tech like hybrid bonding outpace the drag of legacy pay TV declines and executive transitions? It's a fascinating tug-of-war for a company that is quietly powering the tech we use literally every single day. Thanks for joining me on this explainer, and keep asking the right questions.